What if I told you the stock market is basically just the show Shark Tank? On a massively larger scale, of course. But I mean, think about it. The greats like Warren Buffett rarely talk about charts or day-to-day market swings, not because prices don't matter. It's because he's too busy asking the same kinds of questions the sharks do. How much has this company actually made so far? That's earnings. What does it cost to produce the product versus what they're selling it for? That's your profit margin. And the big one, how much cash is the business producing after it pays its bills? That's cash flow. When you piece it all together like this, you start to see the similarities, don't you? Because the stock market isn't just prices moving around on a screen. It's an ocean of businesses, each one offering you a piece of ownership at a certain price. And you get to decide if that price makes sense. On TV, that would make you a shark. In real life, you'd be known as a value investor. And value investors aren't asking, is this stock exciting? They're asking, is this a good business? And am I getting a good deal on it? Here's the first idea you need to lock in. Price and value are not the same thing. Price is what the market says a stock is worth today. Value is what the business is actually worth based on what it earns, what it owns, and how reliably it can keep doing that in the future. Those two numbers move independently, and value investors live in that gap. Let's talk about a term you hear all the time but rarely see explained clearly: intrinsic value. Intrinsic value is simply your best estimate of what a business is worth if you ignore the noise. Think about it like this. If you were buying a small business from a friend, you wouldn't ask, what's the chart look like? You'd ask things like, how much money does the business make each year? How long would it take for this business to pay me back? Or, more importantly, how long am I willing to wait for this business to earn back what I paid for it? That's the question value investors are really asking. Because if a business makes $10 a year and I pay $100 for it, I'm effectively waiting about 10 years for that business to earn back what I paid. That's what people mean when they say 10 times earnings. It's not a magic number or a formula. It's time. If I pay 12 times earnings, I'm saying I'm willing to wait roughly 12 years for the business to pay me back. Why would anyone do that? Because not all businesses are equal. A strong, predictable business with steady customers and reliable cash flow might justify a longer wait. A risky, inconsistent business shouldn't. So when investors talk about intrinsic value, they're really asking, is the price being offered reasonable for how long I'm willing to wait to get my money back? That's valuation. So let's do the math. As a value investor, being able to calculate intrinsic value is the key to determining a good price. For the formula we'll need to start with, our valuation multiple. That is, the number of years we are willing to wait. Let's say, a stable, boring, reliable business implies maybe 10 times earnings. A stronger, growing, predictable business, maybe 12 to 15 times earnings. Let's pick something conservative. $10 in earnings times 12 years in waiting equals $120. Ta-da! That's your estimated intrinsic value per share. And because no estimate is perfect, investors rely on something called a margin of safety. Margin of safety just means this. You don't buy a business at what you think it's worth. You buy it below what you think it's worth. If you believe a company is worth $100 per share, you don't buy it at $95. You wait for $70 or $60. That gap protects you. It's not pessimism, it's discipline. Let's continue with another fundamental tool value investors use to sanity check themselves. It's called the price-to-earnings ratio, or PE ratio. The PE ratio just tells you how much investors are paying for each dollar of earnings. If a stock trades at a PE of 10, investors are paying $10 for every $1 the company earns. If it trades at a PE of 25, they're paying $25 for that same dollar. That doesn't automatically make one good and the other bad, but it gives you context. Value investors compare that number to the company's history, to similar businesses, and to how stable those earnings actually are. The number doesn't decide. Context does. Now, we can use a simple example to bring this all together. Imagine two companies in the same industry. Company A has steady earnings, manageable debt, and trades at a PE of 10. Company B has similar earnings, more hype, and trades at a PE of 25. The market loves Company B. But a value investor looks at that and asks, why would I pay more than twice as much for the same earnings? That doesn't mean Company A will outperform tomorrow. It means the odds are tilted in your favor over time. If things have gotten a bit confusing by now, don't worry. I have another example to tie all three of these concepts together nice and easy. When a company earns $10 per share but trades at $75 per share, that means the PE ratio equals 7.5, or $7.50 for every $1 of earnings. And if your intrinsic value estimate is $120, that means your implied, or the PE you think is fair, equals 12. So, while the market is pricing the business at 7.5 times earnings, you believe a reasonable buyer might pay 12 times earnings. That's value investing in one sentence. And the gap in market price versus your intrinsic value estimate is your margin of safety. Remember, value investing isn't about being early, it's about being patient. Markets can stay irrational longer than you expect, but eventually, business performance matters. Here's the takeaway I want you to leave with. Value investing is a mindset. It's about understanding what you own, what it's worth, and how long you're willing to wait for it to pay you back. When you get that right, time does a lot of the work for you. If this video helped you see value investing differently, subscribe. And if you want the next video to walk through how to analyze a real company step by step, let me know in the comments.